Have you ever considered the impact of a collective of unassuming retail investors on the rigid structure of Wall Street? Let's visualize this. GameStop, a beleaguered video game retailer, unexpectedly transforms into the epicenter of a fiscal power struggle. At one end of the rope, we have the common at the other, formidable hedge funds like Citadel and Melvin Capital. But what led to these average investors creating such significant turmoil? The story begins with GameStop, a struggling brick-and-mortar video game retailer. In a world increasingly turning towards digital downloads and online shopping, GameStop found itself losing ground, and its stock price reflected this decline. That's when hedge funds started to circle. They saw an opportunity to profit from GameStop's misfortune by shorting the stock. Shorting a stock, for those unfamiliar with the term, is essentially a bet that a company's stock price will go down. Investors borrow shares of the stock and sell them immediately, hoping to buy them back at a lower price later, return the borrowed shares, and pocket the difference. It's a high-risk, high-reward strategy. If the stock price rises instead of falling, the short seller is on the hook for the difference, leading to potentially unlimited losses. But in the case of GameStop, something unexpected happened. The hedge funds had bet so heavily against GameStop that they had actually shorted more shares than were available to trade, a risky move known as naked short selling. But what these hedge funds didn't anticipate was a group of retail investors ready to challenge them. Enter the retail investors, ordinary individuals like you and me, armed with an internet connection and a trading app. In an unprecedented turn of events, these retail investors turned the stock market on its head, using social media platforms to rally around GameStop's stock. The chatter, the memes, the rallying cries, it all culminated in a buying frenzy that sent GameStop's share prices skyrocketing. Now, what's a short squeeze, you ask? Well, it's a market condition where a stock's price rises sharply, forcing those who bet against it, the short sellers, to buy it in order to prevent even greater losses. Their scramble to buy only adds to the upward pressure on the stock's price. The power of retail investors, then, lies in their numbers and collective action. With their coordinated buying, they triggered a massive short squeeze on GameStop, causing its share price to surge from around $20 to a peak of nearly $500. This sudden surge in GameStop's stock price put the hedge funds in a precarious position. As GameStop's stock price soared, something controversial happened. The buy button was turned off. This sudden stop sparked allegations of market manipulation, with a spotlight being cast on the mysterious world of dark pools and off-exchange trading. Now, dark pools are private exchanges where trading occurs away from the public eye, often used by large institutional investors to make hefty trades without market disruption. At the same time, off-exchange trading refers to transactions that occur directly between parties outside of or off the traditional exchange. Another contentious practice came to light: naked short selling. This is when a security is short sold without the seller first borrowing the security or ensuring that it can be borrowed. This can potentially lead to an infinite amount of a security being sold short, causing a market imbalance. What's more, these practices raised questions about the very stability of our market system. If unchecked, could these manipulations lead to a market collapse? That's a million-dollar question. Yet, amid all this controversy, the stop of the buy button was seen by many as an attempt to protect the interests of the hedge funds. But was it really? The plot thickens, and so does the intrigue. In the aftermath of the GameStop saga, questions about market fairness were raised. The turbulence shook Wall Street to its core, and the ripples are still felt in the market today. But let's shift our focus to the silver lining. What could this mean for the stock owners if a market crash happens? Believe it or not, a market crash could present an opportunity. It's like a sale in a high-end boutique. The prices of quality stocks are suddenly within reach. For the shrewd investor, this could be a chance to pick up shares of solid, profitable companies at a discount. The key is to remain patient, do your research, and wait for the storm to pass. But the GameStop saga did more than just shake up the market. It highlighted the power of the average retail investor. For too long, Wall Street was seen as a playground for the elite. The GameStop event shattered that illusion. It showed that, armed with research and a collective voice, small investors can band together and make waves in the market. This saga also underscored the importance of transparency in the stock market. It exposed some murky practices like the use of dark pools and off-exchange trades. It brought to light the controversial use of naked shorts and swaps. All these practices, while legal, can lead to market manipulation and a lack of fairness. The outcry for transparency that followed can lead to regulatory changes that level the playing field for all investors. In the end, the GameStop saga proved that even ordinary retail investors can make a significant impact on Wall Street. It may have been a rocky road, but the potential benefits are clear: a more transparent, fair, and inclusive market. And that, my friends, is a win for us all.